Well, speaking of NVIDIA, as we're talking about the company, it just topped Microsoft and Apple to become the world's largest stock. Now, these three are likely to do a dance for the next couple of weeks, but as it stands right now, NVIDIA, the world's largest stock at this moment by market cap. Its market cap, by the way, stands at around $3.3 trillion. And here it is, hitting another fresh all-time high. And it's been part of what's been driving the Nasdaq higher. And in fact, we've seen the Nasdaq hit 6 consecutive all-time highs, driving the S&P to also all-time highs. And it comes at a time, as I mentioned, that we're seeing a deterioration in some other key economic data. And quite frankly, everything else seems to be left in NVIDIA's dust. Let's bring in Ann Sonders, Chief Investment Strategist at Charles Schwab, joining us. Ann, thank you so much for being with us. And I think you're such a great person to talk to on a day where it seems like we're all single stock minded, because let's zoom out, right, and look at the more than 500 names that are left to contend with. The internals of the market are not looking great. You know, as I just listed off the number of all-time highs we've seen on the S&P 500.
Yeah, and we have an incredible spread, an historic spread in terms of how overbought the externals are, meaning at the cap-weighted index level, and how oversold the internals are, meaning the average stock, the rest of the market, however you want to define that. You know, having cap-weighted indexes driven by a fairly small number of stocks is not abnormal, but it's when you have the rest of the market significantly underperforming and breadth as weak as it is, that it does establish some concentration risk. The rub is trying to figure out, which is really impossible, at what point some sort of convergence started. So it could last a while longer, but there certainly is concentration risk in the market right now.
And does that mean that, you know, if there is an oopsie in one of those large players, there's a risk that it takes down the whole market?
Well, by definition, it would mathematically, for the same reason that if you've got a significant upside in this small handful of mega cap names, whether it's just the one stock NVIDIA or the Fab Four, the Magnificent Seven, whatever breakdown you want to use, by definition, it works in the opposite direction. That's exactly what happened in 2022 during the bear market year. Those were the laggards in the index. You know, memories tend to be fairly short when it comes to market behavior, but I think it's instructive to look back. Not that that's a base case for anything imminent. It's just something we need to be mindful of. And the reason why you want to consider as an investor periodic rebalancing in order to keep your own portfolio from having the same concentration problem as is embedded in the cap-weighted indexes.
I think the question is rebalancing to what? And I'd throw out there this read of retail sales that we got that was disappointing, suggesting that, you know, maybe the consumer is landing after all. How do you think about, you know, the fundamentals that are driving the other parts of the market?
Well, I think, you know, weaker retail sales is not a huge surprise, because a lot of the leading indicators for consumption, including the recent report out of University of Michigan on consumer sentiment that showed a massive drop in buying intentions pretty much across the spectrum of the type of goods that they survey about. So seeing that drop in retail sales was not terribly surprising. And but interestingly, we got today in the U.S. the strong industrial production number, particularly in manufacturing. So what we may be starting to see is yet again a roll through. And we've been characterizing this entire cycle as a series of roll through recessions in manufacturing and housing related, offsetting strength in services. And I think we may be starting to see some of that weakness in the consumer, but it's possible we could see some improvement or at least stabilization in areas that already took their hits, like in manufacturing.
And I'm wondering, you know, how this shows up in equities, to bring it back there. You know, like an area like small caps, has that already been kind of flashing some of these warnings? Is there a little bit more economically sensitive?
Yeah, but keep in mind, small caps, especially if you're talking about an index like the Russell 2000, that's got, you know, I don't know, 1,800 and some odd names in it. So don't look at any component of the market through a monolithic lens, as if all small caps are created equal. Really, the quality differential is what's defined areas that have worked within small caps and those that haven't. A perfect example of that would be zombie companies versus non-zombie companies. So as a refresher for people who don't know, a zombie company is defined as a company that doesn't have sufficient cash flow to pay interest on their debt, let alone fund operations. So they're at the mercy of moves up and down in yields. Going back to the beginning of 2023, zombie companies in the Russell 2000 are down 10%. Non-zombie companies within the same index, within the Russell 2000, are up 10%. So you've got a 20 percentage point spread just differentiating between zombies and non-zombies. So there are opportunities down the cap spectrum out of those mega caps, but you absolutely want to stay up in quality in terms of the factors you're screening for within a universe like that.
For a long time as well, the stock market was competing with the bond market because you could get that really decent yield with a lower risk profile. Do you think that is ebbing a little bit, and that investors are more increasingly willing to look to the stock market for both an income but also the growth side?
It depends on the investor, and I think there's too much cookie cutting that happens as it relates to things like asset allocation and moves between stocks and bonds or between cash and other asset classes. Even just at Schwab, we have $9.2 trillion of client assets, 35 million brokerage accounts. That's an unbelievably wide array of investors. And there are investors, whether it's in, say, fixed income like in treasuries, whether it's in something like money market funds, that is money that might actually prove to be sticky. It's money that is comfortable earning, say, 5%, getting that income stream without having to take the risk associated with moving out in equities. For other investors, they might have temporarily just parked some money in those safer vehicles looking for an opportunity, not just elsewhere like in equities, but other asset classes. But to have sort of a blanket answer to a question like that is just simply inappropriate, not just impossible, when you're talking about such a wide array of individual investors and what their time horizons and risk tolerances and need for income, and the list goes on and on.
All right.